Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
What's up, everybody? Today is another fun episode. It feels like the end of summer. So we had to have our returning guest, Mike Philbrick, on to celebrate, CEO of Resolve Asset Management, founding member of the Return Stack team. You know, you can go back to episode 17 to hear him on the show, which is almost 10 years ago. I didn't even know this podcast is 10 years old. It's about to be. What should we do to celebrate? I don't know. Today, we're talking about gold. Obviously, he's Canadian. Getting into a little return stacking, Bitcoin, some other topics. Mike, welcome back to the show.
Thanks for having me, Meb. It's been a minute.
God, what were we talking about 10 years ago? Do you even remember? I don't.
I have no recollection of that whatsoever. I've seen you a few times in between, but
I'll start off your two favorite topics. First being gold. You know, I mean, we're up here hanging out at all-time highs. Spots, what, like 3,500, somewhere around here today?
Yeah.
How's that feel? What are you thinking about? What's the conversation sentiment like there in your world?
Yeah, well, I think just globally, obviously Canada having that mining background, it's always a sort of an ever-present allocation in the index and among investors. And, you know, it's been a bit of a, since 2011, call it till 2023, 2022, it was a bit of a, non-starter or a yawn. But what we're seeing, I think, today is we're at the stage in the adoption curve for owning assets like gold and Bitcoin, where it's no longer contrarian. It's just becoming prudent. You've got this scarce asset that behaves a little bit differently than your normal cash flowing assets in traditional finance. And you're looking at respected institutions and sovereigns and allocators really kind of making the move to include these assets given the current economic regime. And then if we look on the Bitcoin side, you see treasury companies adding Bitcoin to the balance sheet, Coinbase added to the S&P 500, Trump executive order on 401ks, Paul Atkins' speech, American leadership in digital finance, a revolution. And if you put this against the macro backdrop, you're thinking about the U.S. monetary hegemony is eroding. And, that's due to debt and sort of the emergence of a multipolar world. And all of those are shifting policy. And I think the administration understands if you can't dominate the currency, then dominate the protocol. And the U.S. is positioning itself as the reserve platform via USD stablecoin adoption and digital finance infrastructure, and, to some extent, energy and material sovereignty to make a play as still to remain that, sort of have that hegemonic influence. And so as advisors, I think the risk here is shifting. It used to be the risk was having these assets in your portfolio and having to explain something like gold or Bitcoin. I think that's shifting, and it's now going to be failing to understand how these scarce assets work in a portfolio and making sure clients have an allocation to them before they ask you why they didn't.
You guys have a nice paper called Golden Opportunities, and we'll talk about a few of kind of the topics and charts in there. There's a great kind of question, does gold compound wealth or preserve wealth? And that was an interesting way to frame it. I don't know why I think about it this way, but how do you guys kind of think about it in terms of those two things? I feel like most people would think, hey, it's a diversifier preserver, right?
Right. And in fact, what turns out to be the case is it has had a positive risk premium. So when you go back and say, well, typically a hedge would be just something that is flat or maybe even costs you money. But what you find is there's been actually a 3%, 3.6% risk premium to gold post that 1971 closing of the gold window, if you will. And so the sovereign nations of the world have always had in their balance sheet some amount of gold. And now that particular item is heated up post the Ukrainian invasion by Russia and the subsequent seizure of Russian assets by, the West. And that caused other sovereign nations to start to look and say, well, maybe these US treasuries are not the sort of lockdown assets that we thought they were. And if we do something that isn't popular with the West, do we also have this possibility where our assets will be seized? And what you see post that is sovereign nations have been buying about 1,000 tons of gold a year. That's a huge increase. And that I don't think people understand the critical nature of that event where, that the US treasuries were the bedrock of global finance. And that was called into question. And so you're seeing this shift to continue to, I think, gain momentum. And so what we've seen historically is that gold acts as this protector from a monetary debasement, geopolitical risk, and it does have a risk premium. Prior to 1971, if you held it and you could own it, there was no risk premium because it was basically guaranteed money. Post 71, it actually, you are absorbing volatility and you're gaining a risk premium for absorbing that volatility in the asset itself. And this gets to, scarce assets. And how do you think about scarce assets and how they function in a portfolio when you think through the ideas in that, from the standpoint of the risk premium in gold that exists today?
The most mind-bending stat probably of the last year that I've come across, and this is a little study we did, not to dunk on Peter Maluk because I actually really like him, but he had talked about, something about gold, and I don't want to put words in his mouth. I can't remember on Twitter, but it was something about like, we don't love it or it doesn't fit in a portfolio. And I said, well, there's kind of a fun thought experiment is the most ironclad, like you'll never get fired for a 60-40 allocation in the US. You put 60% in the S&P, 40% in 10-year treasuries, like you'll never get fired for that. And it's done great. And so we ran a fun experiment. We said it's back to the early 70s. What if you just replace the bonds with gold? Like what an insane, inane, stupid, crazy thing to do. Like clearly that's going to cause your vol to shoot way up, your Sharp to torpedo, your drawdown to go up. Returns are probably going to be way less. And it turns out that it makes no difference. And this is an astonishing takeaway in my mind. And we're doing this series on the blog right now called 20 Things That You May Not Know About Markets. And this is one of the posts. And of course, I got a zillion responses and people are like, that's only since the 70s. And I actually said, well, you can go back to the 20s, so last 100 years. And it's the same exact thing. You would actually have a similar Sharpe ratio, similar drawdown, similar volatility, similar returns. It's almost as if they're interchangeable. Now, the cool thing is like that, they take a slightly different path. So the takeaway is both would be perhaps better than one or the other, which is kind of the story with all assets. But to me, it's like one of those moments that you can't unlearn. And so then we also follow it up with people and say, by the way, despite how amazing US stocks have been, the premier asset the past 15 years, gold's outperformed stocks this century, which is also astonishing, right? That's 25 years going on. So anyway, there's kind of two data points that when you start to think about, that you start to say, oh, okay, well, that's interesting. Maybe I should look a little more into this.
Yeah. The paper we're talking about, we've got it at returnstacked.com/gold. So if someone wants to take it down and have a look, and just to correct myself, the positive risk premium is 7.35%. The number I was thinking about on the 3.5 was actually if you overlaid a 20% gold allocation on top of your 60-40. So rather than taking stuff out of the portfolio, return stacking it, that's where it adds almost 1% in returns, and it reduces the drawdowns by about 3.5% of the 60-40. So to your point, bonds and gold are an actual better complement than just bonds, or probably just gold, although we haven't done the research on that. It sounds like that's the case.
It's kind of like my one of my few sort of ironclad rules. And I feel like Dalio talks about this being the holy grail, where you put together an portfolio of return streams that sort of zig and zag. Now, those can be beta asset classes like we're talking about. It could be strategies like trend, et cetera. But you pull up a chart, and you guys have a great one, 71 to 2024 from this paper. And we'll put a link in the show notes too, listeners. And it shows, a lot of the assets, yeah, they kind of zig and zag, but gold really zigs and zags, right? Like, especially the 1970s period. Like, when we wrote our GAA book, there's not much else out there that really helped. 70s were terrible for most investors. Unless you had some real assets, and in particularly gold, a lot of the portfolios in the book that were the most consistent across decades had a meaningful allocation to gold. Nothing like 25 years of outperformance to give, to see the mood shift a little bit. But I feel like the discussion is shifting, and all-time highs helps that too, of course, when something's up.
I don't know if you remember seeing, we're in 25, 24. It was sort of in 2023 when the gold price started to move up. And you saw actual net holdings at the major ETFs, the shares decline. So people were seeing the price increase. And while sovereign nations were increasing allocations, allocators were actually reducing exposure. Now that changed in 2024. So we have seen the tick up in, if we look at GLD and the other ETFs and the AUM in them, beyond, so looking at the how many units rather than the net asset value in order to, get the price appreciation out of the way. So the allocation is coming back. And I think it's part of the recognition. One of the things we hear all the time is it doesn't have a risk premium, it doesn't have a cash flow yield. And those types of things are often, sort of at the core of, I don't want to allocate to it. And it really kind of misses the point, right? Psychological commodities are things that come from cultural acceptance, right? We've accepted in this Western world and that gold from probably the 1500s is a store of value. And there's some physical atomic reasons for that. It doesn't, sort of degrade. It stays around. We still have what we mined with the Egyptians and all of that sort of stuff. But there's a difference between that and people conflating it with saying, well, then it's just a bubble, right? It just is something that it's like Beanie Babies, if you will. And the difference there is there's a response mechanism, and you have to have a scarce asset. Things like art, things like waterfront property, things like gold, things like Bitcoin are scarce. If we have a craze in Beanie Babies, more Beanie Babies will be produced in order to meet those needs. And other traditional commodities are similar. If we have a shortage in oil price is going to go up, or we're going to drill more wells, we're going to get more oil. Same in copper or lithium or nickel. The difference is when the commodity that we believe becomes a psychologically accepted asset, when it's truly scarce, that's when you're not able to mine more of it. And as the monetary system prints fiat currency at will, you can't print gold, you can't print Bitcoin. Bitcoin's going to have 21 million shares, 95% of which have already been, I'll air quote, mined. And gold, it's expensive to open gold mines. And that stock to flow is about, sort of 2 to 2.5% new gold is added to the inventory globally as we move along. And so they're truly scarce, which means in order to acquire them, you have to buy them from somebody else who's willing to sell them, and they cannot be manufactured. And this is a feature, it's not a bug. It's the precise reason why these assets behave differently. So stocks and bonds are priced off of interest rates and growth expectations and credit risk and things like that, where gold and Bitcoin, they're going to be priced off of inflation and currency debasement and geopolitical risk and sovereign credibility. And that's what really provides the diversification. Maybe if we go to we've got that economic regime asset class chart to walk through maybe a little bit and just to give some context for people. I'll explain this a little bit for those watching, but you've got two dynamics that impact asset prices largely. There's a third called liquidity, but for simplification, let's just talk about inflation and growth. And if we have those two dynamics and we plot them on a graph and you've got inflation running on the y-axis and growth running on the x-axis, it creates four regimes. And what we've got on this chart are the responses of asset classes when we're in each of these four regimes. So if you have rising inflation and accelerating growth, think about that era from 2003 going into 2008. You've got things like commodities do very well and emerging market stocks do very well. Gold does quite well. US stocks tend to not do that great, or developed market stocks don't do quite as well. They do okay. And when we think about that period in 2000 to 2008, think about, emerging markets, how much they outperformed US stocks as an example. And then you think about falling inflation and accelerating growth. That period post 2008, right? US stocks were unstoppable. Equities generally do very well. Commodities do kind of poorly because it's not inflationary. There's enough supply around. You're sopping up that excess supply. Gold also doesn't do well. Then we get into rising inflation and slowing growth, that stagflation type period, 22, 23, or the 70s. Here again, bonds really get hurt in that scenario, and equities get hurt simultaneously. And this is what we experienced in that 2022, 2023 period, where we saw bonds really not add a lot of diversification. Same as the 70s, right? And finally, you get the deflationary bust, the Great Depression or the 2008 scenario, where equities don't do well, commodities don't do well. What does well is bonds and gold. Those are the asset classes that do well. So if we sit and think for a moment and say, well, we want to have these asset classes in our portfolio. If we're not going to be predictive, then we should own them all in some equal way in order to, balance off the risks. But, I point to today as being particularly relevant in that we are probably not in a disinflationary boom. Given the money that's been printed through COVID, given the amount of infrastructure that needs to be built out for this AI digital revolution, it seems to me that the inflation headlines are far more prominent. And if we're in an inflationary regime, so we've got rising inflation of any kind, which puts us, whether there's growth or non-growth, gold and those scarce assets become core providers of not only stability, but return. They provide resilience and return. And then obviously the opportunity to rebalance within the portfolio as you go through these events. And so I think that's what makes it particularly relevant today.
One of the cool things you guys do in some of the papers, you're talking about home bias, you're talking about how it fits in. Sizing on the gold side, and we'll come back to Bitcoin in a little bit. How do you think about that part of this? You can give the Canadian answer or the answer you give to everyone, but like the standard American, how do you think about sizing gold in the portfolio?
I think you can think about the sizing aspect from a couple of different angles. It depends on what you're trying to achieve in the portfolio.
Dominance, trying to achieve dominance. That's the
global dominance. Then 65% in gold. I'm not kidding. We've got a paper called Using Gold, the Gold Stack to Hedge U.S. Home Country Bias. So U.S. investors, and you've talked about home country bias ad nauseum, they often have an allocation to their home country stocks they know, love, and trust that's beyond what it would be in the global sense.
The crazy part about this is one of our 20 things you may not know about markets. I feel like people kind of get home country bias, at least my audience does now, because we don't shut up about it nonstop for a decade. And it's a terrible, no good, horrible idea to put all your money in one country. But it's also a bias within where you're born within a country. So like the US, for example, if you're born in the Northeast, you mostly own financials. If you're born in Texas, you know where this is going, energy. If you're born in California, it's tech, or live in those states. And then here we got a chart. It's also when you're born. And this one makes sense too, because it's your like formative experiences. I love cheering for the Mets because when I was 8, they would have been in that period with Dwight Gooden and Darryl Strawberry and on, right? Like the very formative years. And it's probably the same thing with the formative years on when you invest. If you invest in the last 15 years, all you've known is a U.S. romping, stomping bull market where you buy every single dip, and that's how it works. If you go back and read books like The Great Depression, A Diary, that wasn't the case. And so Vanguard tracks this and looks at the allocation to equities just based on, when you're born, and it's hugely different. And some of the trauma, if you live through the GFC or 1987 or in other countries, all the various crashes and situations, it's a hugely impactful input that most people, I think they're totally immune to. But the reality is we're all shaped by our experiences. All right, keep going. Sorry.
100%, Matt. I agree wholeheartedly. When I first got into this business and was dealing with private clients, I was dealing with some of the silent generation and the great generation where the banks had collapsed. And so they took delivery of all their certificates. Having a certificate in street name was suicidal to them because they're either them or their parents had a situation where all of that disappeared. And so they would literally have their securities in a safety deposit box. They'd have their bonds with the coupons attached. They'd go and clip the coupon, take it to the bank, redeem it for the cash that was there. And it was their formative experiences that alerted them to the risks. The experience alerted them to the risks that are present that we accept as sort of, very low probability in today's world. But I couldn't agree with you more. We've got a chart up just showing sort of the historical allocations to gold. Now, this is an implied allocation where U.S. global investors has sort of looked at what's the allocation of all the gold ETFs compared to the ETFs out there. And so in 2008 to 2012, you had a bit of a crisis. You had upwards of sort of getting to 8% allocation in gold. And today we're sitting at 2%. But we're also seeing sovereign nations start to stack gold in their vaults as well. So the amount that you would stack depends on a couple of things. What's realistic? So in the one paper that we've got, the gold stacking gold on the 60/40, we do a 20% return stacked overlay. And when you overlay a 20% position in gold, which I grant you is probably a stretch for most, but it's funny how the narrative will evolve. So 20% sounds like a lot today, but a little bit more of performance and more intuition built around scarce assets, you may get there. But if you look at that back to 71, you get an extra, just call it 89 basis points, so % more in return, and you cut your drawdown by about 3.5%. So that's a meaningful increase, and that's in the period that is ended in 2024. Going forward, that contribution could be much greater, could be less too.
I feel like people, as I think about 2%, this is of all the things, probably the most extreme barbell, because I feel like people either have 0 or they have 10. I feel like the average is somewhat misleading when it comes to gold, because you have the Canadians, the Aussies, the Chinese, the Indian, or people that are the bugs are going to have a lot more. And then there's people that have quite a bit less. I mean, all of our strategies our allocation strategies have a default gold allocation. And then on top of that, obviously, you have the momentum and trend portfolios, which can give you a pretty big outsized gold allocation, which has been the case for quite some time, including the miners. We haven't even mentioned the miners, which have been historically a kind of a laggard, but they're doing their best to catch up this year and recently.
The other way to approach it is to think through this overallocation from the home country bias and try to attenuate that using gold. Often what domestic stocks do by overallocating them, you're overallocating to the US dollar. And so in a world where we're experiencing the de-dollarization, as well as I think the stated objective of the administration to make the dollar more reasonably valued globally for various economic reasons, then you can start to think through, okay, well, what do I want to, I want to maintain my US equity exposure, but how much gold will I allocate to in order to start to hedge that? So if a US, typically the beta of gold to relative international stocks is about negative 0.63. So let's say you had a US overweight in the global portfolio of 12%. You need around a 4.5% gold overlay to effectively hedge that US dollar short that you have, if you will, by not owning those international stocks. And so you can get that with, again, a gold overlay, which is a nice additive benefit to an allocation to gold. So it can help offset some of the home country bias that investors experience. So you can keep your US stocks, but if you stack gold on top of the portfolio, you're hedging a bit of that away from the US dollar.
Well, I feel like people have been kind of, particularly Americans, a bit complacent, just got kind of used to this environment where the dollar just kind of kept going up, and all of a sudden, bam, this year has been a big move in the first 6 months. And for a lot of people, that's a bit of a surprise or just a bit different than what they've been used to.
The largest decline in the first 6 months since the 70s.
Yeah.
So it is an outlier. And so that those international stocks are doing well, partially because some of the stocks are doing well, but a lot of that is coming from currency.
I wonder what the Venn diagram is with the coiners and the gold bugs. Like, is there a lot of overlap now? I feel like that overlap is getting bigger. I feel like a long time they were extremely separated and almost antagonistic. Like almost you got like Pomp and Schiff just kind of battling it out. But I feel like that's changing. Do you feel that way or what?
I think it's changing in some domains. So I think that when you look at, again, coming back to the investor's age. So if you look at the millennials, they're sort of definitely Bitcoin friendly and also are starting to realize that these real assets like gold are interesting. If you look at the sort of the boomers, the mahogany desk money, if you will, that's largely underweight Bitcoin, but has some familiarity with gold. So I think that in that sense, there's a bit of a bifurcation there in the markets. Although I do think that the boomer crowd is warming to the idea of Bitcoin in the portfolio. But you do see that difference in age cohort for sure. And when you see the surveys out there and things like that.
I think one of the biggest truisms of markets for me is following the flows. And I was going to pull up real quick the total, what's the total crypto ETF landscape? It's over 100 billion now, right? So yeah, you get IBITs at 85 billion, and then, oh man, you're probably 200 billion now. So one of the things that's always been a truism to me is whether you agree with something or not, paying attention to flows and paying attention to assets that just kind of the trend following side of it, that just don't quit, don't stop, I feel like is a great philosophy, whether you hate this idea or not. Give us a little bit about Bitcoin, the biggest differences. So we talked a little bit about are gold and coiners the same people? And I feel like the advisor mentality, like the average advisor in the US, if you're allocated to Bitcoin and gold, you tend to be open-minded, maybe. I don't know. Anyway, talk to us about the biggest differences. And the biggest one, that Rod was saying earlier was that Bitcoin is just hella more volatile. I think he said it was like a 5 times more volatile than gold. Am I quoting him right?
Yeah, it's 4 times. But here's the funny thing. So that's a bit to unpack there. So certainly the younger audience identifies with Bitcoin, and Bitcoin has some of those same attributes we talked about earlier with respect to scarcity, right? There is only 21 million that will be mined. 95% have been mined, and it's not in 5% of portfolios. So that's the asymmetric return opportunity that Bitcoin may be bringing to the portfolio that gold may be lacking, or the additional advantage. The other thing is that Bitcoin is a little bit more, when you think about the advantages that one might consider that Bitcoin has over gold, you've got this ease of transportation. It's borderless, it's immutable, it's tariff-free. And, despite that short-term volatility, if you're rebalancing in the portfolio, I think that makes a lot of sense. And it doesn't require any kind of third party or a third party entity to validate the transaction, right? It's validated on the blockchain. So it's transportable across borders. So that gives it some advantages over traditional gold as a scarce asset in a digital world. So here's a couple of interesting factoids. One is that NVIDIA is a pretty large position in the indexes. We agree. So everybody in the world owns NVIDIA if they own an index. The volatility of NVIDIA is higher than the volatility of gold at this point. So the volatility aspect of it can be a bit of a misnomer. People say, it's too volatile for me. Maybe historically, if we look back over time, it has had volatilities as high as 80 and 100. The recent volatility is in the 30s and low 40s. And NVIDIA's volatility is higher. So investors are comfortable with higher volatility assets once they're diversified across some other portfolio assets, and once they build some intuition around that. And I think as Bitcoin becomes more and more institutionalized, and as you see these, you've already pointed out the massive growth we've seen in ETFs, which then translates into the futures markets, which then translates into hedgers and commercial people buying it for different reasons and having reasons to hedge it and people being short it. If you go back to 2017, in those bubble markets of Bitcoin, there was no derivative market. The only way you could buy it from somebody is to buy it from somebody. And that creates some massive upside spikes and then some collapses, right? When you start to roll out institutionalization of a product and you build in derivatives and you have commercial markets in there being long or short for various reasons and for different objectives, all of a sudden the volatility of the asset is going to normalize. Is it going to approach, gold at 10 to 15? Probably not. So when we think about that in the platform that we have, the ETF we have rather, RSSX, which is return stacked stocks and Bitcoin and gold, what we do is we equal risk weight the two assets. You don't want the maniacs running the asylum, if you will, right? So what we want to do is, in this case, currently, it's about 4 times more volatile than gold, Bitcoin is. So you're going to hold about 20% Bitcoin and 80% gold. That way, the volatility contributed to your portfolio by these scarce assets that are adding this additional value is equalized. And we look back about 500 days and we constantly update that so that as Bitcoin falls in volatility in the future, if that's the case, then the piece that is Bitcoin is going to expand to reflect that. If it rises in volatility, the converse will be true. So when you think about approaching it from a risk-weighted perspective, that allows your stocks to be complemented by both gold and Bitcoin in an equal risk-weighted sense. Now, we do sponsor another fund, BTGD, which is $1 of gold and $1 of Bitcoin. And so, the maniac can run the asylum a little bit on that one. And the nice thing about that, when you stack, that stack, BTGD, has outperformed gold and Bitcoin. But that's for sort of someone who just wants to think about it simply from a capital allocation perspective, isn't too worried about the risk side of it.
Well, that goes back to the comment earlier where we were talking about, the gold in the portfolio versus U.S. bonds, and everyone wants to think in binary terms. Is it gold or bonds? But in reality, both are probably better. And so same situation here. Let's do a quick double click while we're here, because you mentioned, you guys really have been pioneers in this return stack concept. How many, you guys got almost 10 funds now. How many funds do you have?
7 funds.
Awesome. All right. So give us a little overview. I see our old friend managed futures with stocks, bonds and managed futures, U.S. stocks, futures yield, bonds and merger arb, stocks and gold, Bitcoin, and then Bitcoin and gold, and then global stocks and bonds.
Everything in the return stack lineup starts with the idea of you're going to get $1 of beta that you already know, love, and trust in your portfolio, whether that be stocks or bonds. And you're going to stack a diversifier on top of that. So with an additional $1, you're going to get that exposure stacked on top. And what this allows the investor to do is forego the opportunity cost of being out of the assets they know, love, and trust, like stocks and bonds, while building in the diversification that they know they need in those market duress times, and attenuating the tracking error and the behavioral error that comes with, allocating to alternatives. You take that classic 50, 30, 20, where you give up 20% of your stocks and bonds in order to buy alternatives. It's a funding issue, right? So now you've given up those things that your clients are really looking at you to track, to buy these things that are supposed to keep you safe or diversify you. And at times, they don't work like you expect them to work. So if you look at trend funds over the last year, let's say, they're maybe producing a 2% return. Well, if you've given up 20% of your stocks and bonds to pursue that 2% return, your opportunity cost has been 20+%. So rather, stack the trend portfolio on top. Don't give up those betas that love, and trust. We also have, that's managed futures, focuses on trend. The carry side of things is managed futures and focuses on the yield. And obviously, we've talked today a lot about the Bitcoin gold one, which is, again, when people are sensitive about those traditional assets that have those cash flows that they know, love, and trust and are familiar with, well, let's not take those out of the portfolio. Let's stack these diversifiers that are resilient on top of those stocks that you really like in your portfolio. And lastly, I will highlight the RSSB, which is the sort of capital efficient core ETF, which is just global stocks and US bonds where you get $1 of each. So that way you can build your own adventure. So, if you've got some Cambria funds that fit well in there and they're diversifiers, rather than selling some stocks and bonds, buy RSSB. Let's say you buy 10% of RSSB when you've sold 20% of your portfolio. That replaces all your stocks and bonds. And it gives you 10% to build your own journey. What are the alts that you like in the portfolio?
I remember chatting a bunch of these ideas when we were on the boat in Cayman and thinking about the combinations that made the most sense and what's really cool ideas here. And, I did a tweet that it's kind of evergreen because I run this poll every few years in different formats to just try to, when I'm feeling particularly good, I want to depress myself up a little bit. And so this poll is a variant, and listeners have seen it over the years, where basically it's asking how long could you hold an asset, and said differently, sometimes I'll say a portfolio manager or strategy or something. What stretch of underperformance would you be willing to tolerate before you sell it? And so this most recent one, we did 3 buckets: 0 to 5 years, 6 to 10 years, over 10 years. And 71% of people said 0 to 5, and another 21% said 6 to 10. So under 10 years, you're at 92%. And the crazy part about that is, we just illustrated, for example, that gold has outperformed stocks for 25 years. There was a period in 2022 where bonds had outperformed stocks for 40 years. And so these periods, I think people, and we see this with our own funds, sadly, where people just chase performance and all of them. And it's not something that I'm trying to become at peace with, which is hard as the PM, because you see people kind of just doing the wrong thing at the wrong time consistently over and over. And one of the nice things about the return stacked is it gives you that blend, right? So by definition, when you have 2 assets like gold and Bitcoin, one is going to be underperforming the other. Now, they both could be up 25%, who knows? But one just mathematically has to be doing worse. And sometimes they'll do substantially worse, like you mentioned, managed futures not having the best last 12 months. And so it perhaps makes it more palatable. We'll see. It'll be a fun behavioral study if y'all's stuff is less return chasing than I think a more specific assets. And managed futures has always been a pretty big unlock here for me, I think, the idea. But it'll be interesting to see the really volatile stuff like Bitcoin and perhaps gold, depending on what's going on in the world. Do you feel that similar, or have any thoughts on that?
We've seen the exact same sort of behavioral vulnerabilities across portfolios over the last 10 years. When performance is hot, money does stampede in. And this is a real challenge. And that was one of the core reasons for thinking through return stacking in a way that could help attenuate that. So, as your diversifier is having a struggling period, we're rebalancing that within the funds, right? So you're still getting $1 and $1. So if your $1 of trend following or your $1 of Bitcoin gold is going down, you're adding to that. And so giving you some diversification premium, some benefit from the rebalancing. And the rebalancing is key, and the rebalancing is hard. I know you've seen it probably in your experience, is that people don't quit on an asset class or a strategy when it's shining in the bright sun and having its best moments. They quit when it's having its normal course drawdown, and thereby locking in the losses and foregoing the gains and the diversification benefits that come from the strategy when the sun starts to shine again. And so return stacking was all about trying to attenuate that. Start with an amount that you can stick with. Start with an amount you can actually add to in a drawdown. Then when you start to see the benefits of it in portfolios, and you build that intuition that you have, that you're building for you and your clients, you can start to add more and build a larger diversification into the portfolio. whilst keeping the stocks and bonds that your allocators, your clients, the people that you deal with, they just know, love, and trust, and are going to sort of rank you on those tracking errors.
Yeah, I feel like it'd be interesting to kind of, as you guys have the conversations, what tends to be the biggest use cases? I mean, there's obviously a leveraged use case. If someone said, hey, I just want to add more of X, there's sort of the strategic, home bias rebalancing where there's like, hey, I actually just want to add some exposure or strategically rebalance this portfolio. And then there's also like the kind of like, I'm hiding this for my clients, like I'm buying this gold and Bitcoin because I want to add this, but if I buy straight up Bitcoin, it's going to generate a million questions and these clients are going to ask me, it's like a career risk element, right? Where you say, oh, you have this, you idiot. Why did you buy this? Bitcoin went from 120K to 20K. Whereas if it's mixed in with something, it may be less offensive. Do you feel like are they kind of all part of the picture? Is there any one that stands out? And I guess it's probably fund dependent too.
Yeah, it is all part of the picture. And we call it cloaking, right? So you want some gold in your portfolio, but there's probably no more polarizing line item in a portfolio than gold. Maybe Bitcoin, right? So let's not put the line item in. Let's put it in the return stack portfolio and let's let it do its magic behind the scenes. That way you don't have the line item risk where, first of all, they're going to see the Bitcoin go up by 5x, and then they're going to ask you why you didn't have more, right? There's both sides of that conversation that occur. Well, I want to add more to it now, and you, the advisor, saying, well, no, your 1 or 2 or 3 or 4 or 5% allocation is quite good. We should be there, and we actually should be rebalancing down. Nothing makes me happier when I see advisors and allocators actually, we've had great performance, and they rebalance down to add to other assets. It happens very rarely.
As a unicorn advisor right there, I'm sorry. It's a Monday morning. I'm grumpy because, I've been writing a piece, like basically it's like thinking about philosophically how to approach selling funds and saying that you can't use performance as any of the criteria. And I feel like that would flies in the face of what anyone would ever do in reality. Right. But I said, like, philosophically, that's probably the best advice, and so yeah, if you're one of those unicorn advisors out there, God bless you.
If you can stick to a simple logical algorithm, right? Is the strategy broken? Yes or no? If yes, it should be sold. If no, and it's going through a normal course drawdown, then that's when it can add the most value to the portfolio to be rebalanced towards. And if you can get yourself thinking in that way and allocating in that way, you will be more successful. You'll take advantage of the diversification premium that you can take advantage of. And that happens internally in our funds automatically. So when stocks are ripping and trend has had a rough go, we're clipping a little bit of those stocks, rebalancing to $1 each, and adding to the trend following or adding to the carry. When Bitcoin and gold are ripping, we're taking a little bit off the top of those. We're adding back to the assets that are underperforming. And all of that's done on behalf of the client, the advisor, automatically. It's Groundhog Day. It works. You just wake up and you do the same thing over and over again, and it works. But it's hard to do. So we want to take that burden off of the advisor, right? Build it right into the portfolio and help attenuate the tracking error that comes from that funding issue on funding those alts. That's what return stacking seeks to do. And I think it's gone well so far.
What's the majority of the underlying for these funds? Does it vary? Is it futures, ETFs?
It's both futures and ETFs. So when you're trying to create these portfolios, you do have to use some leverage, and you are entering the futures market because it's so efficient and so cheap. So you're looking at SOFR is what the cost of margining is in the futures world, which is interbank lending rates. So it doesn't get any cheaper than that. And we do try to hold as much of the underlying as we can. So you'll see in the portfolios, if you look at the holdings, you'll see in RSSX, for example, you'll see IVV and you'll see IBIT. And we try to hold as much of those as we can with a liquidity buffer. And then we recreate the exposures using futures in gold and the balance of the Bitcoin and stock. Same thing in the managed future space. So there's a large holding of the underlying asset that is, if it's stocks, IVV, If it's bonds, it'll be a ladder of futures. And then you're conducting the trading of the managed futures product on top of that, which is quite efficient. You don't need much of the capital to do that.
What else? You guys got more, funds in the hopper? You thinking of many other pair ups? Like, because, as you know, like doing product development, sometimes you come out with an idea and it's a category creator. Then all of a sudden you get a million people right back and they're like, oh, this is cool. But what you really want is gold and Bitcoin or whatever. Are you guys settling in at this sort of 8 number, or are you going to be a teenager?
We're looking. Oh, the one that we didn't cover is merger arb, which is, I think, a great, again, that is a really unique diversifier, in that, you've got your, sort of your bonds, and then you can take credit risk. Well, that credit risk is actually not correlated at all to merger arb. And so when you lay merger arb on top of your bonds, you have this new and different type of added value in the portfolio. So that was a recent addition as well. We're pretty excited about that. And that can complement bond portfolios, I think, quite nicely, because you've got your credit risk, you can do some duration, and then you've got merger arb that you can lay on top as well. But it's really quite hard, actually, to think about what are sort of durable strategies where you're confident that they're going to produce this excess return over time that you can stack on top. What we do hear from people is, hey, I'd like this stacked on NASDAQ, or I want it stacked on more and more international now. So as international gets a bit of attention and heat, folks are saying, hey, why don't you stack on that? What we need to see, obviously, is enough demand that makes it worthwhile. Managed futures also serve a similar role to gold in that they do help with that home country bias as well. That's probably a topic for another day. But nothing is obvious at the moment, right? It's been, something like extremely wild would be a super growth stack of, NASDAQ and the top coins, non-Bitcoin, Ethereum and Solana and Sui. That's, again, hard to get in the wrapper, though. Half the time the challenge is, well, what's the wrapper that you're going to offer the strategy in, and can you actually execute the strategy and stack it in an ETF wrapper?
I thought you were going to say the Canadian barbell, which used to be cannabis and gold miner stocks, but cannabis has been left for dead. But there's some rumblings today. I don't know. We'll see what the administration in the U.S. is doing. Who knows?
That's a classic one for your 5 years down strategy.
Oh, it's not 5 years down.
I know we're 6 or 7 now or something.
No, I think if you use the largest ETF, I think it's 8. It might even be 9 if you included this year, but I think it might be up on the year now. These things go up and down 20% a day now, so who knows? But, this is, when we ran the study, we did major indices, which usually don't do 3 years in a row. So that's like S&P, bonds. Then you had stock sectors, which are obviously going to be more concentrated, more beta. And then, those got you out to like what you're talking about, like the 4 or 5 years. And then you had the industries, and you guys can go do this on French Fama database last 100 years. And I think the record for that was always coal stocks. And that happened a couple times. And then, but I think that was like 6 years in a row. And then you have the granddaddy of them all, cannabis, which is really a sub-industry, right? That's not even tobacco. It's like tiny. But I think it was 8. I think if you look at like MJ and including this year, 1, 2, 3, 4, 5, 6, 7, 8 years in a row. So,
hey, but look, if you look at the price action today, if you close here, you're probably going to close above the 10-month average on the monthly charts.
Here you go.
You can allocate again.
Yeah. So advisors, you guys want a particular mashup, reach out to these guys and let them know, because I'm always open to these crazy ideas. What else is going on in your world? We touched a lot. We hit some topics. Anything else that we missed that we didn't get into?
Well, we're holding a symposium in October 8th in Chicago. And we're having, it's a portable alpha symposium, because at root, that's what return stacking is, right? It's taking those lazy assets that you have and using them as collateral to add diversifiers. That's in the institutional world known as portable alpha. And we've got some institutional speakers. We've got someone from Canada Pension Plan who specializes in that. We got Jonathan Glidden, who is famous for bringing United Airlines pension plan back on on side using some portable alpha strategies. So there's some very, very good guests help advisors get their minds wrapped around how they can use portable alpha to really, kind of shift the efficient frontier upwards. And if we do get this sort of time frame when stocks and bonds start to correlate, this is going to become very important. Adding assets like gold and Bitcoin, adding strategies like managed futures to maintain that diversity and that, that sort of C curve in the efficient frontier. And then if you can shift it up a little bit, even better.
Who gets the invite for this? Is it for advisors, individuals? How do they apply? They just show up?
And it can be found on the returnstacked.com website.
Very cool. Great time to be in Chicago in
getting
October.
Close. Yeah.
I love it.
Yeah. Not terrible.
Philbrick, this has been a lot of fun. People want to find out more. Is Return Stack the best place to go? Where else can they find you guys other than at the local pub in Cayman out on the Stingray Bay?
Return Stacked in Return Stack Portfolio Solutions. ReturnStackETFs.com is the actual ETF page.
Philbrick, it's been a blast. Thanks for coming back on this 10-year anniversary. We'll definitely have you back on before 2035.
I love it. Appreciate it. Always a pleasure, man.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.